good afternoon, good evening, good night, or good morning, depending on what part of the world you're signing in from. Is an unusually international audience today, so I really appreciate everybody's time in joining us. And today I'm joined by First Mining CEO Dan Wilton and Brien Lundin, Director of the New Orleans Investment Conference, Editor of the Gold Newsletter, and more. Both of you gentlemen, thanks for joining me today.
Hey, Romeo.
Great to be with you.
Awesome. So starting a conversation really about a couple things. As the price of gold rises, it's really interesting to talk about which projects are now much more attractive perhaps than before. So I'm going to jump right into the protein of today's discussion, and then we'll get into audience questions. So this is an interactive event. That chat button on the bottom right of your screen, you can ask questions at any time during the event. We'll try to get to them at the end. If they fit perfectly, I'll try and sneak them in. I know there were some questions that were submitted in advance over email, so I will be trying to get to those as well. So if you wrote one in over email, I'm trying to get to them today. But I'll go ahead and get started and say, Dan, if you'd be so kind, could you give a brief synopsis of First Mining and its two flagship properties for those who don't know the story?
Sure. Thanks, Romeo, and thanks everyone for joining us today. So First Mining is advancing 2 of the 10 largest undeveloped gold projects in Canada. Our Spring Pole project, which is located about 100 kilometers east of Red Lake, Ontario, is in advanced stages of environmental assessment and actually targeting submitting our final environmental assessment document there at the end of this month. So really from a permitting perspective, one of the most advanced in Canada. It's a large multi-million ounce 1 gram gold and 5 gram silver open pit project. Our second asset focus project is called Du Parquet. It's located about 10 kilometers east of the Quebec-Ontario border in Quebec, in the heart of the Abitibi gold region. And it's a past producing, it's actually got 3 past producing mines on the property. And again, a multi-million ounce endowment that we put out a PEA on last year, showing a combination of open pit and underground mine that's capable of producing 200,000 plus ounces a year. So both large scale projects in tier 1 jurisdictions, very well drilled and in advanced stages of development.
Awesome. Thanks for that summary. Brien, I'll throw one to you right away. What do you look for in a development story when gold's at 2,600? What kind of price do you look at for ounces in the ground that's really, really attractive to you?
Yeah, the prices I look for now are something that to some degree we never expected to see, which would be companies that have large scale, and in First Mining's case, 2 of the largest around in the market today. Big gold resources, largely defined, well understood, economics applied in some cases, and selling or trading for less than $10 an ounce in the ground. Now that is something that's been around for a while. You know, we've had that the last couple of years where we've had a lot of companies like that. But we've never had, and never could imagine having this situation with the gold price of well over $2,600 an ounce. You know, just a couple of months ago, I put out a few pieces to my readers saying gold at $2,500 changes everything, because just a few weeks earlier we were around $2,200, and all of a sudden we're up $2,500. And it hit me that all of those optionality plays out there, all of those companies that were formed, you know, in some cases over 10 or more years ago to try and acquire big gold resources that were out of the money. They weren't economic at current gold prices. They'd been forgotten about the market, but they were huge, huge resources. And at some point the gold price would rise to the point where they would become economic, and therefore their value would just explode higher, going from essentially, you know, in some cases zero value just as an option on gold to real substantial value in the ground. And none of those projects, maybe not none, some of the diehard bulls maybe imagined it, but they were thinking maybe one of these days gold will get up to $2,000 an ounce and these projects will be economic and they'll be worth so much more. And all of a sudden, the gold price had surged to $2,500 an ounce. So I put out some pieces saying gold at $2,500 changes everything. In effect, all of those optionality projects, all of those out of the money projects that the diehard gold bugs loved, were suddenly not only economic, they were wildly economic by hundreds and hundreds of dollars an ounce. And then I had to retract that. I had to, just a couple of weeks later, put something out and say, cross out the $2,500 and say gold at $2,600 changes everything even more. And then we were getting close to $2,700 and still not that far away from it right now. So it's just been an absolute whirlwind over the last few months, and the market has not adjusted, has not re-rated these projects to match. So yeah, I'd like to look at $10 an ounce in the ground or less, because that's what a lot of these companies are trading for. So beyond that, that seems like something that would be too much to ask for, but those opportunities are out there. Beyond that, I'm looking at, the stage of those projects. Are they more advanced? Have they checked off a lot of the boxes in terms of risk? Have they made these more appealing to the majors, which really is the ultimate end game for these projects? And we're getting there. There's a lot of opportunity out there right now, and First Mining is one of the premier ones out there.
Great. And somebody in the chat asked, honestly, a better formulated version of a question I already had right up next, so I might as well sneak into that. He asked if high gold price is great for exploration, great if you're already producing, but he's curious how much the price of gold actually impacts new builds leading to production. That's I was curious on how you should evaluate the potential of well-established projects versus exciting exploration plays. Dan, I can throw it to you first there on that one.
Yeah, well, I mean, I think, I'll give you the view of someone who's in that development cycle. Investors have historically tended to look at these projects on a net asset value basis on a certain gold price, and that's often a gold price published in a report. Now, most of those reports require you, whether by code or convention, require you to really look at kind of a 3-year trailing gold price average. And that's what we've used in both of our technical reports on Springpole and on Du Parquet. But that can lead to, in the environment that Brien has articulated so very clearly, where you've seen the gold price, run this quickly, that really does lead to this sort of disconnect between the fundamental value sitting in these projects and what it could be, the leverage that these projects have. Now, the gold price running doesn't necessarily impact, you today, per se, right? You still have to finance and build a mine. But, often, and we've been looking at a couple of cases of this as we start thinking about financing Springpole, the reality is you can, I was talking with someone the other day, you could put a costless collar on production at Springpole if you were debt financing a significant portion of it. Put a costless collar on with a floor at $2,300 or $2,400 right now. So that is something that when these projects go through the development cycle, they get to that construction time frame. The reality is, like, you're just by virtue of where the gold price has moved, you're still seeing this real disconnect that can be closed by the financial markets, which is interesting because I haven't seen a market like that really. Brien, I'd have to go back to 2010, 2011, when you had gold really rocket, past the global financial crisis and rocket up to the previous highs of 1900, that you saw this disconnect where the 3-year trailing was that much lower. So, I think it's starting to reflect in the fundamental value, but it hasn't really seemed to hit on investors' registers yet. And that's the opportunity here, is that if you believe that the gold price is going higher, these averaged 3-year trailing average gold prices, I mean, we put out our study at Du Parquet a year ago, and it was done at $1,800 gold. That was the 3-year trailing a year ago, So how is that going to step up? It's going to step up slowly over the next year, and then it's going to start moving up very quickly for those studies and kind of project financing exercises coming out in the future. So, it's again, I think the biggest thing for us in the projects that we're looking at, and our peers that Brian's talking about in this $10 an ounce category is, there are hundreds of millions of dollars of margin in these projects that's been created by this gold price move. And in our case, for our projects, every $100 of the gold price is 250 million US of after-tax NPV on our projects. So it really is kind of the embodiment of this real leverage that you're looking for, because the other thing we can look back at historically is when these projects get acquired, they tend to get acquired for between $100 and $200 an ounce. So in some senses, it then becomes, what's the time frame that these projects could be in a position or be of interest to get acquired, which these days is largely driven by your permitting timeframes. What's the time frame that they could be, a bona fide acquisition candidate, and what's the probability that they get there? And I don't think there's any rational probability that can be applied today that justifies a sub $10 an ounce valuation.
Oh, fair enough. Brien, I'll let you get in there on the same topic.
Yeah, and Dan, as usual, did a great job of covering it. But one of the things, he talks about how a lot of these projects are priced at 3-year trailing prices. Well, on the other end of it, they show their sensitivity to the gold price, if prices would drop or prices would rise. And the sensitivity tables are they're just candy for the gold bugs, typically, because they look at it and they skip the downside part. They go to the upside. What will this company do if we get up to like $2,000 or $2,100 gold? None of those sensitivity tables have ever addressed $2,500 or $2,600 gold, because they would have looked stupid doing so, and they would have gotten their hands slapped by the regulators if they would have. So that's the question here. Dan did a great job of in his case, showing what $100 means, but you can't find that in any decks for companies, what that means. And that's the key here, is a disconnect in the industry where there's real value there that is yet to be realized. Now, I'm not here to argue it's going to be, these projects going to be re-rated next week or next month. I think Dan has a good point there, that it's going to happen over the past year, of the next year or so, and then probably very rapidly after that. But once it starts to happen, it's going to be applied across the board, and that opportunity will close. But we're talking about tremendous opportunities here. We're talking about the kinds of returns that you would be looking for in a grassroots drill hole play exploration story of 4 or 5x or more. You can get that kind of upside potential right now with companies that have proven projects in the ground. They found the gold. They've outlined it. They've done numbers on it. They've de-risked it. It's sitting there. It's a backstop. Under $10 an ounce in the ground, it's not going to get much cheaper than they are trading for right now. So the risk reward dynamic is as good as you're going to find, and I think as good as I've ever seen in my career in this industry.
Great. I do want to talk about timing, actually, because you both kind of brought it up, and it is something I want to talk about next. It's always hard to tell what kind of news, especially I think in the last 3 years, will really drive appreciation in a mining security. So I'm curious for both of your perspectives on what now are the pieces of news that will really move for development stories, and what type of investors are going to be leading that charge. Dan, I can start to you first. Or Brien, go for it.
Brien, you go first.
Okay, I would say that in these kinds of plays, the best news for any company in the junior sector are great drill results. That's the key. Everything takes a backseat to that, except in this specific area. I would think the takeout of a similar company would be the kind of a thing that would supercharge the entire sector and start force the market really to start re-rating and reassessing all like companies. So far, we really have not had that to a great extent, I think, in this at these price levels. So it will be interesting to see what happens. particularly on the valuation standpoint. If a major could come in and pay double what some of these companies are trading for right now, give 100% premium to the market, and that major could feel like it got a hell of a bargain, and would, in fact, have gotten a hell of a bargain. So it just, I think, takes the first domino to fall in this kind of a situation to create that kind of a market. And once one major goes, then the available pool of takeout targets is reduced thereby, and the rest of them are going to look at it and say, well, we'd better move fairly quickly. And that's the kind of environment we've all been looking for years. And I think it's just right around the corner at this point.
Yeah, and what's funny about that, Brien, when we look at that, we've got a nice slide in our presentation that lays this out. We put this together in advance of a presentation earlier this year. Just curious that we'd seen all of these projects falling off the development curve, right? By getting acquired. And when you actually go back to look, and we're focused on 5 million ounce plus projects in Canada, but you go back to 2020, Artemis buying Blackwater. You had the funding that went into Osisko. You had B2 buying Sabina. You had, funding that went into Cote. Even if you go back further than that, almost every one of those projects of 5 million ounces or greater in Canada, and not Greenstone is another great example, they were acquired pre-construction for in excess of $500 million. So call that $100, up to Osisko just set a $200 an ounce kind of benchmark. So it has been happening, which is the funny thing and the frustrating thing from our standpoint, because you've seen a number of those deals that have actually happened, direct comparable projects. Look at what was available to build in Canada 5 years ago versus what's available to build today. And there are 7 fewer projects on that, ones that have been built, sure, but most of those have been financed at, or acquired at significant values. So no, I think it's been happening. I was kind of hopeful that this latest Goldfields Osisko deal was going to sort of start the firing gun to start the race. But that list is getting shorter and shorter. So I totally agree with you. I think that's, in the near term, one of the things that is going to be very clear is starting to see companies come earlier stage. And that's the other thing that I think when you look at where companies are along that development pipeline, with our Springpole project, it's one of the most advanced in any permitting process. I think when you start seeing strategic acquirers saying, you know what, at this value, I can take permitting risk. These projects are in good jurisdictions. At this value, I think, I'm willing to come in. So when you start seeing hopefully more strategic investments, that helps open up access to capital to get more work done. You start seeing projects getting joint ventured or getting funded with partners. And then you start seeing those big premium cash takeouts. And by that time, I think we're already going to be well and truly into the raging bull part of the cycle.
Dan, you bring up a good point. I'd like to get your view on this. I just thought of it as you were talking about some of those examples you're bringing up. Not all of them, but some of them were companies where they were building those projects, finding those ounces in a tough market. Yeah. So they were spending a lot of money in a bad market, diluting their share structure, and eventually sold because they just couldn't keep advancing it, couldn't keep diluting it, still at large dollar values. But Sabina, for example, was taken out at something like a 20% premium to its share price, but half of its peak share price. So at this point in the market, when we look at those companies with those 5 million ounce level projects, they've already diluted, they've already undergone that, they've already spent the money. So you're not going to get them, they're primed for a takeout, in other words, and takeout at values that would represent significant appreciation from where their share prices are, because they don't really have to dilute anymore to advance the projects, or not to a really significant degree. Do you agree with that?
I think so. I think the one caveat that I would say, and we're living it, is that the permitting process is expensive, right? And for all that, people think about that dilution you have to take for a big drill out, and that's significant and something that is by and large behind our projects. So, just by virtue of Spring Pole having a couple 100,000 meters into it, and Du Parquet now almost 300,000 meters. I think there's still that time and spend in terms of getting through an environmental assessment and permitting process. And we can tell you very clearly that is a very expensive process. You got to carry all of your corporate costs over a 5 to 7 year time frame, and that alone adds up for a lot of these developers. Right there, if your corporate costs are $3, $4, $5 million a year, that ends up being a big chunk of your market cap. And I think in the market we have been in the last few years, that's one of the biggest points of concern for all shareholders. And that's fundamentally what I think what drives that sub $10 an ounce is that concern for future dilution, right? It's that concern about availability and access to capital, because it's been tough. We're starting to see it open up. We just have closed a couple of equity financings. We brought 15 million into the company. When we did similar exercise about a year ago, that number was 10 or 11, largely from our existing shareholders. It hasn't really broadened out and gotten easy yet, but we've seen a few of our peers starting to get funded in the 20, 25 million range. So the access to capital has opened up a little bit, I think, because a lot of people see the value, but most of that is existing shareholders who are coming back to support companies. I think there's still that time frame, and still you got to get through these permitting processes until such time as you start having the larger gold companies actually deciding they're willing to take on that risk. And they can price that risk because they know roughly what it's going to cost. They're not going to have any problem funding that amount. They're well resourced to get things through that. It's just that binary risk and call it a binary risk on permitting, that they've been unwilling to take, in large part because they've been rewarded for waiting. And that's the other thing that's unique about where we are in this sector right now, is that by and large, the strategic acquirers have been rewarded for waiting because things have just gotten cheaper. Now that it feels like we're seeing a bit of a turn, when we start seeing the broader market, a lot of the traditional investors in our types of companies who see this value and start front running that, it's a bit like, getting good action on a fishing rod, right? At some point it causes the strike. So I think we're getting closer to those times now for sure.
Great. One thing, and Brien, I'll put you in first on this one, but happy to have both of you answer for it. That's not to say that you guys are old, merely experienced, but this isn't your first cycle. Okay. I'm curious, in the last time the gold had a run, a genuine one, not a couple months, what did the market make of late stage permitting stories? Where did they go? Which ones, made headlines for being picked up?
Yeah, I would think if we're talking the last really big cycle, we were talking around the 2009, 2010 standpoint, where companies did get rewarded and takeouts were at significant premiums, and things have not gotten as cheap as they get right now. But the best person to answer that is Dan, because he was a big time operator in the market back then, and firsthand experience on a lot of those stories.
Yeah, we were talking about this the other day, Brien. Just so happens when we think about a bunch of those stories in that time frame, I was an investment banker with a team that had a reasonable practice of raising equity for single asset developers and ultimately selling those developers to larger companies who ended up moving them forward. So just give you an interesting example coming out of the global financial crisis of 2009. we'd started working with a company called Terrain Metals that had the Mount Milligan project. Mount Milligan is a big, what was then considered low grade, today call it kind of a mid-grade copper gold porphyry in BC. Project with a checkered past and had caused more than one CEO of Placer Dome to get fired, as I seem to recall. But this was a period where, the gold price was moving into a point where these projects were going to make a lot of sense. Large tonnage, low strip, you could build it sizable, and off you go. So we started working with this company. It had a market cap probably sub $100 million. And from 2009 to the middle of 2010, that market cap went from 100 to about 500. Gold price was going up, copper price was going up, strategic value of these assets was going up, and in that time, it got its final environmental assessment approvals. So again, just check that one more box that made it something that was actionable by the larger companies, and ended up getting acquired by a company called Thompson Creek for a value of in excess of $700 million. So kind of 7x on your market cap in call it a year and a half. And so I think we're poised for those kind of moves. In that market, those were the companies that everyone wanted to invest in, right? And a lot of those mines are now the largest mines in Canada. You want to talk about the stars of the last cycle? It was Osisko with Canadian Malartic. It was Detour, which was kind of at the tail end of that. The Detour ended up getting financed, I think, a little bit after 2011. And there was Mount Milligan that we sold, Blackwater, kind of the real discovery and consolidation of Blackwater, that we actually advised on the sale to New Gold for $500 million pre-PEA. So talk about companies willing to acquire resources. It was very similar to sort of what we've seen with Kinross and Great Bear. Magino was another one that's now built and producing. Again, going to be a great mine, just got acquired by Argonaut, by Alamos. These big projects that were the market darlings. And in large part, they were the market darlings because they did exactly what Brian's talking about. Over the course of a short period of time, they went from, being valued at, $10 an ounce in the ground to being valued at 50, 60, and then getting taken over for billions of dollars.
Somebody in the chat straight up said, Dan, don't sell for less than 10%, please. Much appreciated. Smiley face. So
love it.
Reviews from the live audience.
There we go.
There's one question kind of really specific to Springpole that I wanted to bring up. Thought we have talked about market factors, and you did reference what's coming up, but I know folks in the audience are looking to make money and curious what are the catalysts and milestones that prompt that journey at Springpole specifically from here?
Well, I think for us, a lot of it is that driving desire to be, an overnight success story 6 years in the making. Really, since Keith put the company together in 2015, next year is going to be 10 years in the making. It's a lot of hard work that's gone into it. But for us, submitting that final environmental assessment, so we're submitting our final EA at the end of October, which is a major milestone in any project. But I think it reflects an enormous amount of work that's gone in to the environmental assessment process. That's not the end of a journey. To be honest, it's the start of a journey. And there's still a lot of important work that needs to happen there, particularly, review and more commentary from the Indigenous communities that we're working with around the project. Like, there's still some really important process, but we have been discussing the project, and, certainly with the draft EA that we published in 2022, there has been a lot of discussion that's already happened, but still some really important discussion to happen there. And then ultimately, again, our goal of signing agreements, call them impact benefits agreements with the communities that we're working with. We'd like to hope that process kind of runs in parallel with the EA process. But I think, we're targeting that final EA approval at the end of next year. And that, I think, really sort of sets that project as, one that would have a lot of those risks substantially addressed. And if we're having those discussions in a gold market that's $2,600 or $2,700 or $3,000 an ounce, again, it's going to open up a lot more of those sort of financing options or the attractiveness to move this project forward with a partner. So lots of big catalysts coming up there for sure. Still, again, lots of hard work to do. Still a real process to go through. But yeah, lots of exciting times in front of us here.
Action coming up, always fun. Brien, there's one question that came in for you via email in advance, but Dan, feel free to jump in afterwards as well. And that's somebody wanted to know your perspective on buying physical gold and silver versus buying mining securities. Is there a split that you recommend, or what is the advantages to one over the other strategically?
Yeah, I tell people that there's two reasons to buy gold. One is as insurance, the other is as an investment. And the most important is insurance, because you're insuring your wealth against something you know is going to happen. You have home insurance, but you don't really expect your house to catch on fire. In terms of your wealth, you know that the dollar in 5 years or so is going to be purchasing a lot less than it is today. The trend is clear. You just don't know the precise amount. It could be relatively little. It could be an awful lot. Regardless of that, over these kinds of broader sweeps of time, gold has always protected purchasing power. So for whatever percentage of your wealth that you can set aside, instead of, say, holding it in cash, hold it in bullion, gold and silver bullion, then that's insurance against something that is an inevitability and not just a possibility. So that's important. Everybody needs to do that to some degree, to whatever degree they're comfortable with and lets them sleep well at night. I can't advise anyone on their individual situation, but a certain significant percentage of your available wealth should be insured by precious metals, because you know what's going to happen. The other thing is, when you see the macro picture, and if you determine that it argues that the gold price is going to trade much higher relative to those fiat currencies that are losing their purchasing power, then you can try to leverage that situation through investments. There are a lot of ways to gain leverage on gold. There are more ways today than ever before. There are 2x funds for both bullion and mining stocks. There's futures and options, of course, if you know what you're doing. But one of the best ways, time-tested ways, and really exciting and fun ways is through mining stocks, because these are inefficient markets. And the further you go down the food chain towards the juniors, through the developers into the juniors, the more inefficient it gets. And that means that you can gain an edge on other people who don't do the work, who don't devote the time and effort and, yes, some money to learning about the sector, to subscribing to newsletters, to going to the best conferences, to talking to management teams, because on occasion and quite frequently, this market leaves the real values behind, overlooks them temporarily, just diamonds in the dust, as it were. And in some cases, as we're speaking today, entire sectors. It just is not that efficient, and it doesn't re-rate these projects, these sectors, these kinds of companies to where they should be on an immediate basis. So it's quite frequent to see this thing kind of happen. I think it's very rare to find a situation where it's this obvious and this broad and this compelling as what we're talking about today.
Appreciate that, Dan. I don't know if you want to get in on the strategy of physical versus securities.
Yeah, I mean, I think Brien's articulated it in a way better than I probably ever could. That there is, preparing for the inevitability or insuring against the inevitable is a pretty good bet. So, I think there's all kinds of room depending on risk tolerance. And that's what I've told people. I was a professional mining equities investor for for 5 years. When I talk to people about it, it's about doing your homework, and it's about understanding your own risk tolerance and understanding the risk of those investments. And that just comes down to having an understanding of what can go wrong in the life cycle of developing a project, and how hard it is to go from, mineral tenure and one good drill hole to a mine. Like, that whole journey is really, really difficult. There's lots of things that can go wrong. So, I've always kind of gravitated to, the deep value space in the sector. That deep value space for me has almost always been in the development and looking at the relative value of development assets. Because in many cases, there's nothing wrong with the projects. They're good assets. They're good development projects. They've just run out of capital, which happens in cyclical industries. The management teams haven't had the capital or the inclination or the skill to be able to take some of those risks away. And so, as Brien said, you can find those diamonds in the dust here. It really does take a lot of time. But what I've learned from my career is, being right but early often feels a lot like being wrong. And so that's been the challenge of investing in developers for the last 12 years, is there's been a lot of right but early. We've all seen this coming, maybe not as quickly, certainly this year, as the gold price run up has come. We see this strategic market setup. I've been doing this for 30 years. I've never seen a strategic market setup like we have right now. You've never seen a value discrepancy between producers and developers as large as it is right now. So, it's a perfect setup for accretive acquisitions in a time when large cap producers have struggled to replace ounces in their own pipelines. So, again, it's a different sort of inevitability that Brien's talking about. I think his insurance. You're not insuring anything by buying a gold developer. Let's be clear.
Sure.
There is an amount of speculation that comes with this, but I think, again, when you can find good projects in good places with good teams, you can actually articulate that risk reward and make that investment decision.
Great. Brien, we kind of got into this earlier, but I do want to just to put a fine point on it. What for you as a personal investor, what's an attractive entry or accumulation point? Either in catalyst or in value, looking at stories in the permitting process?
In the permitting process, one of the things Dan was talking about earlier is that it is expensive to go through that permitting process. And that's a risk that a company can check off. So one of the things you look for, not so much as a catalyst, but as an asset for these companies, is how advanced they are. You can drill off a project, find the limits, and have a little upside. It is important to have a bit of upside and mystery left in a project. But the difference between a company that has just circumscribed a resource and one that has circumscribed run economics and is well down the permitting path, has the social license, those are the ones that are going to be the first to go off the board to the majors. So it's not so much a catalyst. As I was saying earlier, for these kinds of projects, the first one or two dominoes to fall in the market at large is an important catalyst. But as far as comparing apples to apples, these kinds of companies, that's very important to know that they have a good technical team that's done the proper work, whether on staff or as consultants. But that permitting process, that is key. And the social license is key. And a major does not want to go in and try and take that kind of hair off of a project. They don't want that kind of a risk. So they're comparing from a number of projects in the market. The one that has a solid foundation in terms of permitting and social license is the one that's going to be the first off the board.
Great, appreciate that. Now I think it's everybody's favorite activity, which is crystal ball gazing. I always like to ask, I know you guys run a panel, I think it was in February. Dan was he was the only person in the early part of the year to whisper 2,300, 2,400, I think even almost was whispered. So I'm curious for both of your perspectives, where does gold go before Christmas? So in the near term, and then as a side on, what would that mean, whatever your number is, for projects in the space?
Well, this market in gold is one that, and I guess it's this way always with gold, but the near term is harder to predict than the longer term. And and also we get very superstitious in this market, so I don't want to jinx it either. Dan had the fortitude to risk that way back when and fell short, but it wasn't right, Dan. You fell short.
That's true.
But I think we have the momentum here to get over 27, 28, thereabouts. And one of the ways I kind of deflect from these types of predictions, being in the business long enough and to have grown smart enough never to give a price in a time at the same time, I look toward the end of the cycle, and one of the charts that I include in all of my presentations shows that the previous three bull markets, and in fact the only three bull markets in gold, because prior to that gold was actually money and not an investable asset. So you're looking at the early 70s, late 70s, and the 2000s. Gold went up anywhere during those three markets from 5.6 times from the low to 8.2 times. So if you place the bottom in this bull market at around $1,040 like I do, you're talking about $6,000 to $8,000 gold by the time we get, at the end of the cycle, whenever that may be. And I think that whenever that may be is 3 to 5 to, more years down the road. But I think we have this cycle of central bank interventions in the markets that is 4.5 decades long, that is in its end game. We know where it's trending to. And at that point, when this cycle kind of culminates, I think we're looking at $6,000 to $8,000 gold.
Appreciate that. Thanks, Brien. Dan, go for it.
No, I will step off the curb with.
Take your win, Dan. Take your win.
Oh, no, I've already won. That's a great thing, Brien. I've already won. I was wrong, but I was definitely wrong on the right side for all the home team here. No, I would. I think 2,800 by the end of the year feels to me like if you started the year where we started, where it should finish, and on a continued upward trend. I entirely agree, and have often used the exact same analogy that Brien has. Only looking back one cycle, he studied it longer than I have. But you think about gold in the early 2000s to gold in 2011. And that was basically 6x. And that's what I always kind of think, trough to peak. That's what you should see in a gold cycle. So we're on the way up, and it's great. I think that's exciting. And we're on the way up in a period, and the difference, the major difference in the industry at this point in time is that unlike any other real period in the mining sector, the industry has been remarkably capital constrained for 8 years leading up to the run in the gold price. And so the first couple of years, there's lots of balance sheet repair and people are paying back debt. Almost everyone who's needed to raise equity has now raised equity. Balance sheets are in the best shape that mining balance sheets have ever really been in. But they have not invested in resources and extending resources, and not invested in new productive capacity. And lest we forget, this is still an extractive industry. And when you produce an ounce of reserve, it's out of the ground and it's gone. So you do need to replace it. Higher prices help that for a period of time, in large part because you'll see producers all raise their cutoff grades. And raising the cutoff grades will add ounces. It always does to a certain point. But they've done that a couple of years in a row now. And so they're kind of getting to the limits of existing ore bodies. I think we are coming to a point where there is going to be a real supply constraint. So, to me, I think it's a very exciting time when you think about if we're at 2,600 pushing up to something that's 5.8 to 8 times higher, there's still a lot of room to run here. And I think specifically for us, the projects that we have in advanced stages, and where we could be a year or 2 years from now, it's pretty exciting.
Awesome. So there are a lot of questions both in the chat and that came in over email. Dan, a lot of them are rapid fire for you about spring pull. So if you don't mind, I'm going to put you through a quick gauntlet of just quick spring pull questions. Sure. First, somebody asked, is there a skilled labor pool to draw from for construction and extraction processes on site or in the region?
There is definitely a skilled labor pool in the region. You got to remember, we're not that far from Red Lake, Ontario, but they've been mining gold since the 1930s. We're not that far from Dryden, Ontario, which is a town of 5,000 people that's, I think 5,000 plus, that's have grown up around a very significant pulp mill that's been there for decades and decades. And that whole area of northwestern Ontario, really does draw a fair amount from Manitoba and other places west as well. One important thing to remember on that front, though, is, we've been in this position in the last 4 or 5 years in Canada where we've had an unprecedented number of large projects built, right? You go back to 2019 when I started, no one was ever going to build Côté or Magino or Hard Rock or Back River or Valentine or Blackwater. You fast forward to today and almost all of those projects are now built. So you've had this constructive, productive resource skilled labor pool that's been building projects in Canada, and generally, one after another. And we're coming into a point where at least our permitting timeframes tell us there's not a lot that gets built between now and 2030 in Canada, because there's not a lot that's as far advanced in the permitting process as spring pull is. So from that perspective, that labor pool is pretty mobile, and we'll get to the projects that need to get built.
Perfect. Somebody asked at 2,600 gold, what do you consider the per share intrinsic value of First Mining shares to be?
So we have a couple of slides in our presentation that it takes a little bit of math to kind of work that out. So starting with spring pull at $1,600 and Duparquet at $1,800, we think that's about, call it $2 a share of net present value, just from those. Every $100 in the gold price above that is $250 million US of additional after-tax NPV on the projects. So running in at $25 or $26 a share, just the straight line of that math would, and to be clear, it's not a straight line, and there's cost inflation and other things that happen. But if you just project that as a straight line, it takes you north of $5 a share. And that's, one of what we think of as the 3 real fundamental points of leverage in the company. One is that leverage that big projects give you to increase net asset value through gold price increases. The other is just that leverage to advancing projects and increasing your net asset value per share multiple from sub 0.1 to 0.5 or 0.6, where these things have tended to trade. And the third is the leverage that you get through exploration and adding resource to the projects, which we're certainly demonstrating at Duparquet.
Great. I'll get Brien in actually for a question that came in over email as well. Now, this one, I've asked it to you before. I think I've asked it to a lot of people this year, but curious just for your quick take on why do you think there is a disconnect between, increasing disconnect actually, between the price of physical gold and the miners?
I think all of the believers were already in the gold price. I mean, in the miners. So we're all in it. We live and breathe it every day. We talk to each other. We get depressed together. We get euphoric together. We go to the same parties, et cetera, et cetera. So the mining share market had all of its dedicated buyers already in the market and sitting there and sitting on their positions and not willing to sell them in many cases to each other. because he didn't want this guy that they'd gone to the same parties with to win without them, in any particular stock. So the key is you got to get the generalist, the infamous, the famous, the legendary, generalist investor into the market. And that's a process, because this was an unusual, and I would say a unique gold bull market, because it began without anyone in the West, hardly anyone, I'm exaggerating, of course, involved in it and excited about the gold price and bidding it higher. It began in February and March with central banks buying hand over fist and Chinese investors and savers buying as the gold price rose. They don't normally do that. They've never done it before. They always buy in price declines, but they didn't have any other alternatives in their market for investing. They bought gold on the way up. So with the Fed putting off the pivot, which is what all the Western investors were getting excited about, the first little bump we had in the year when they were expecting 5 or 6 Fed rate cuts this year, and that factor kept getting pushed back in the calendar. You would have expected the gold price to lose $200 or $300 from that level with that kind of a disappointment. Instead, the gold price added $200 or $300 before the Western investors started to price in the real pivot coming when it did at the end of the summer. So the Western investors never got into it till starting in July. They started buying the GLD ETF and other physical metal ETFs. In fact, the holdings in the gold ETFs were falling even during that big rise in the gold price. So that's a proxy for Western investors. And they were selling into it. They were actually providing the gold that Asians were buying. They started pricing it in July. They started buying the ETFs. Then they started in September to start buying mining stocks. And it's a process. They're going to start buying the indices, GDX, GDXJ. Then they're going to have to outperform their peers. So they're going to start looking at thinking they're masters of the universe, and they'll figure this thing out, and they'll start going down and buying individual stocks. And then how do you get more torque? You work your way down the food chain into the developers. And so it's a process. It doesn't happen overnight. It has happened more quickly in the past because we've had bull markets in gold that surprised the faithful, surprised us who are in the market. All of a sudden, like, oh God, we got to rush in and get in because we know what happens in these markets. We've been trudging along for years now, being believers in the gold price, knowing it's inevitable, knowing it's going to run, and buying these stocks and being in the market. So the faithful, the true believers had already bought, and now it's a matter of converting the masses, converting the heathens to the gold and mining stocks. And, it takes a little time. It's a process, and it's happening right now, I think.
Appreciate that, Dan. Throw it to you if you got a thought on that as well.
No, I couldn't say it any better than that. I think some of the other catalysts that we've talked about have been, at least perceived to be slower to coming too. The industry needs to play a role in this as well. And the industry's role is for producers to start providing capital to development projects. And that's starting to happen, but not at all in a pace that we might have seen in previous cycles. And that's going to change. And that's going to change because the people who are really, really benefiting from a cash flow perspective of gold at 26, some of them selling gold forward at $2,700 an ounce, are the people who are producing and selling gold. And so you're going to see that free cash flow. This next quarter is going to be really interesting because, most of that free cash flow from the industry almost doubled from Q1 to Q2. You still had a lot of people selling gold on the way up, but, in Q3, not a lot of people will have clipped a whole lot of 2,600 plus. But Q4, they started by selling gold at 2,600 plus. That's a massive amount of margin. You're talking about easily a doubling or tripling of the free cash flow margin of the industry. That then is only going to exacerbate all the other issues around scarcity of deposits, and scarcity of opportunities to continue to add productive capacity to keep their production profile. And at that point, those investors and the very smart ones that Brien was referencing, they're going to start actually rewarding companies with a growth profile, which also has not happened in the gold sector for years. And so then there is an incentive. They see their multiple higher because they have reserves, resources, and they have a development pipeline. That's what encourages more active competition for assets. And that's, another one of those things that is a firing of the starting gun in the race.
Appreciate that. Now, folks in the chat, there are some questions just on time I'm not going to be able to get to today, but the ones about First Mining, I will pass through directly to Paul Morris, who will get back to you shockingly quickly. So you'll get answers to those very, very, very fast. I will shoot a couple at you real quick, Dan. First, there's a disagreement in the chat, but Adrian asks, is First Mining in an ETF? If not, how likely is it might qualify? And Mark directly under says, I don't want them in an ETF yet. I like us at these prices to stack, but curious what you think about it.
Well, Mark, I encourage you. A lot of your board and management have just added to our position. Just look at our insider filings; they've all gone up substantially in the last week. I've added in the last week 2.7 million shares, so 2 million bought in the non-brokered private placement, and then I paid the taxes on some RSUs that I had. Because again, the price is going higher, and I'd rather have my cost base set lower. So we're not actually in any ETFs in a meaningful way right now. We came out of the GDXJ in 2019. So as it's another thing is that passive money, again, the opportunities start dwindling. You see market cap, that's another real accelerant for the sector, is when that passive money starts needing to look for down market, whether it's on cap or on development timeframes. So another opportunity there.
Great. Two real quick ones, and then I think we do have to jet. First, somebody asked, is First Mining still a shareholder in Treasury Metals?
Now Next Gold. Yes, we are. Yeah, we sold some of our Next Gold shares in the just in order to get a few Next Gold shareholders positioned in the run up. But no, I think we still own 3.3-ish million Next Gold shares, and they've just announced obviously the merger with Signal Gold, and an exciting story potentially coming together there too.
Awesome. And I'll end with two pieces of praise from the chat when it's there. I always like doing it just to gas you guys up. But Diego says, as a junior investor, all the interviews Dan does help me to figure out how to look at companies in the mining sector. Very nice. And Rustics Farm says, Brien, first off, I think he said first of old, Brien, which I'll leave it to you whether you think that's offensive. He says, I find your newsletter to be an incredible resource, especially as you got involved with juniors. Easy choice to invest in the newsletter. So want to end on praise for both of you directly from the chat.
Thank you.
That's great. Thanks.
So both of you, this was a really great conversation. Obviously, this was recorded, so it'll come right to your inbox afterwards. I know there were some folks that registered but weren't able to make it just because of timing. We'll end up your inbox tonight. You will actually be watching this in the replay, so there you go. Everybody, thank you so much. And Brien, Dan, I'll leave it to you for last words before we jump off.
No, just I want to thank Brien and sharing his insights here. We've participated in a lot of conferences, and I don't think there's anyone that's had the longevity and commitment that Brien has to the sector. He's a very important person in our industry, and I think he has amazing insights. So just appreciate the opportunity to share some time with him today with everyone here.
That's why everybody has that Freudian slips like first of old when they talk about me. Man, thank you. Yeah, I would just like to say that I have been in this industry an awfully long time, a few cycles under my belt, and this is a generational opportunity we have right now. It's like nothing I've seen since the early 2000s. It's even better than that, because in the early 2000s, we were hoping that someday we'd see record high prices on gold that would bring the miners along with them. And now we have the record high prices. So first half of the equation, the first step in the process is done. You just need the second half, and that's going to happen for the very reason that Dan just mentioned. These cash flows are something that will bring even the most diehard anti-gold bugs in Wall Street kicking and screaming to the table because you can't ignore those kinds of funds. So you have to take advantage of this kind of an opportunity. I'll get in a quick pitch. The best place to be in this kind of a market, especially at the outset of it, is the New Orleans Investment Conference, November 20th to 23rd, coming up very quickly. I can attest to that fact. Just go to neworleansconference.com and you'll get all the details on our very exciting agenda for this 50th anniversary New Orleans Conference.
Awesome. Dan, Brien, thanks so much for this. And everybody who joined, thanks for your time as well. Have a great afternoon.
Thank you. Appreciate it.
Thanks, everyone. Yeah.
Cheers.
Ciao.